Well, thank you as always for choosing to spend your valuable time with us here today. I am really looking forward to this conversation. I know I have taken this much for granted and have been guilty of not arming myself with the information that I need. So when I had the opportunity to meet our guest today, I wanted to make sure to bring him on to help empower you as well. So we're going to be talking with Andrew Parrillo about negotiating with investment advisors and negotiating your investments. So welcome, Andrew. It's great to have you here with us today.
Thank you, Cindy. It's a pleasure. I'm grateful for the opportunity to be able to share the experience I've had in this, what is often an intimidating process for people.
Yeah, it is. I think a couple of things happen. I think it's an intimidating process. And also for those who don't have the knowledge, I know certainly as a lawyer, and I know most of the people in that profession and others as well, my thought process was I just don't have the time, right? So I would just pass it off and hope that somebody else would deal with it. So just for our listeners, for those of you who may not know Andrew Parrillo is the author of Beat the Wealth Management Hustle. Love that title. He's also the founder of Newport Capital Advisors. He's the founder of Victory Road Investors. He's a general partner of a multi-manager hedge fund. Comes to us with decades of experience. So why don't you start us off, Andrew? Tell us what led you to create your own firm?
Okay, well, what led me to create my own firm in 1995 is that I did not necessarily agree with the disclosure that the firm that I was with was making to its clients. And even though they were compliant under SEC rules, the rules were fairly loose, frankly, in terms of disclosure. And what the firms were doing was not disclosing the sources of income that they were deriving from their client assets. And I thought that was wrong. And so I started my firm. And I can go into more detail on that, but that's the bottom line. And so when I started my firm, it was to be fully, transparent and fully disclosed, and also to charge fees that were fully disclosed and not hidden. So many people pay. What prompted me to write the book, and also to start my firm, but write the book, was I was at a holiday party in December of 22. Now in 2022, the stock market was down approximately 20%, and the bonds were down approximately the same, which is unusual, but that was the case. The Federal Reserve had started to raise interest rates aggressively in March of 22, and it was impacting market prices and investor psychology. And so I was at this holiday party, and I didn't know anybody. There was a Rotary Club party, and so I didn't know anybody there. I was a guest of a friend, and I introduced myself. Well, hi, I've got 3 sons and 3 grandchildren. I was in the investment industry till a fefew years ago, and I retired. Oh, what should I do with my account? I get questions from strangers.
Yeah.
Like, wow. You have an advisor? Well, yeah, I have an advisor. I said, well, I no longer am giving investment advice, and I don't do it casually in any events. But you might want to ask your advisor what you should do. But and I'm pretty sure what the advisors would tell them at that point, after the market was down 20%, is just stay the course, be patient, it will come back. Maybe we should, just be patient, because it'll always come back. And that's the right advice, by the way. But people were they were asking a complete stranger what they should do after a 20% decline in their portfolios. And it's like, I think you probably, and if I were to be honest, if I had that little bubble, out there, I would have said, you should have asked that question a year ago.
Well, it totally resonates with me, because I've got to be honest. Like I've had a financial advisor for 35 years now, but I can't remember a time we sat down where I actually got financial advice or even a discussion about any of it, including the cost. So, and I know when we first met, you shared that it's a little known fact that investment advisors must be prepared to negotiate their fees to be compliant with regulatory requirements. And that interested me, because I wasn't aware of that. So tell us a little about that.
That's a Securities and Exchange Commission requirement for registered investment advisors who are legally fiduciaries, which means that they have to put their clients' interests before their own. It's important for clients or prospective clients to remember that they have the power. If we're talking about negotiating, when you're negotiating, you have to believe that you have the power, that you have the knowledge, and you have the power. So let's start out with the knowledge part. The knowledge comes from asking questions. You ask questions, and you know what you have, and it's a valuable resource to that prospective or existing advisor. Why is that? Well, if the advisor typically advisors charge their clients based on the percentage of the assets under management. And it's usually around 1%. It could be more, it could be less, but 1% is not a trivial number. It's a big number, and I'll explain that in a minute. But so what that means is they get 1% of your assets, or a portion, 1/365th of that every day is what they get. Do they work on your account every day? Probably not. Do they work on your account every week? Maybe, but it depends on what the strategy is, as to what they're doing. But generally, people are long-term investors, and they take a position, they allocate assets to securities or a fund, or an ETF, or like exchange traded fund, and they hold it. And they only adjust that ratio based upon client, preferences, or should anyway. But the fact is that they don't really do anything, but they're getting paid every day. Think about it. If you have an attorney, you know how much you're paying your attorney, and generally you know what you're getting for that fee.
Yeah.
And it's spelled out pretty clearly in your engagement letter or your oral agreement with that lawyer. The same thing with your CPA. You pay the CPA, you know what you're getting, you know when you're getting it, and you know how much you paid them. The same is generally not true with investment advisors. And that's one of the reasons I wrote the book, is that I started asking friends of mine with advisory relationships, how much do you pay your advisor? Gee, I really don't know.
I have no idea. Yeah.
So it's not a trivial number. You should probably ask. And my brother, who's a retired trial lawyer, by the way, whose wife is a top trial court judge in her state as well, and his son is a district court judge. I mean, this guy's a lawyer, right? I mean, lawyers, that's the family business, is law.
Yeah.
And so I said, so Bob, how much you pay your advisor? He said, and he's retired. He said, I really don't know, but I really enjoy the polo matches that she invites me to every year in Newport. He's in Rhode Island. And so I said, well, maybe you should ask her, how much you're paying, but also what are you getting from her after the fee?
Yeah.
How much money does she make for you after you pay her fee? He said, yeah, it's a good thing. I really should be cross-examining her.
Yeah.
I don't think I have to cross-examine an advisor. I think a few polite questions are in order. And those are the questions that I outline in the book. But keep in mind that knowledge is power. And if you know the first question is, what are your fees? And then the next question is, how do you add value to my account, to my portfolio, to this relationship?
And hold on, before we get into the question, so I want to circle back to something, because you sort of threw out about fiduciaries. And I remember a couple of years ago being very surprised. I'd gone to this big finance event, and one of the things that kept coming up is, make sure that you're dealing with a fiduciary in terms of your investments, because most people are not necessarily dealing with a fiduciary, and they don't even know the difference. So can you, for our listeners who don't know that, explain
Securities brokers are not legally fiduciaries. Now, they do have an obligation with a recent September 2020, or June 2020 rule that came out about best interest, clients' best interest. And they have to disclose in a conversational way in a document that they provide to the client, what they do. So the client asks a hypothetical question and they pose the answer and so forth. But brokers are not necessarily putting their client's best interest first. That's what the regulations deem to be the case. I mean, I think it's backwards, but that's what the fact is. Now, registered investment advisors, who are also subject to SEC, Securities and Exchange Commission, and also state administrator regulation, are fiduciaries. They have a legal obligation to put their client out, there's a client interest first. And if they do not, they're subject to censures, fines, closure. And the SEC doesn't mess around. Now, having said that, as a long time practitioner in selecting investment managers for my clients, who in turn my clients were endowment trustees. I had endowment funds as clients and wealthy families as clients, and they were basically trustees for the money that they governed, that they were a governing board of a fund. So they had a fiduciary responsibility themselves. But then I had a fiduciary obligation to them and to their fund. But don't think for one moment that because the SEC is responsible for regulating this industry, that it's going to save you from making an error of judgment on a manager. It may not. And and I mean, we don't have to go very far to find examples of that. I mean, the most dramatic one, of course, was Bernie Madoff
Yeah.
back in 2008. And he was not even a registered advisor, by the way. He was a
Yeah.
broker,
Yeah.
right? And he just defrauded people. I mean, he was a
Yeah.
fraud. Frauds, I mean, so I think that what the bottom line of this is, you have to make your own inquiries and,
Yeah.
understand that, if people are going to be dishonest,
Yeah.
you have to be, what can I say?
Yeah.
When I interviewed managers, and I had to do this, and I not have to, I love to do it. I would really be looking for a few things. I'd be like, do I like this person? Do I trust this person? Is this person passionate about what she is doing or what he is doing?
Yeah.
Do they explain simply how they add value to their strategy?
Yeah.
And if they can't do that, and you can pick up pretty quickly if somebody's dancing around and not answering a question. And you don't have to be a trained attorney to do that, or a trained investment person to do that. If you ask a straightforward question and you don't get a straightforward answer, and then the next question is kind of, you get a squishy answer, maybe you have your answer.
Yeah. Well, and it was interesting because I hadn't appreciated that distinction between fiduciary. And I think so many people jump to like whether the big bank or big financial institutions and their investment portfolios, but I hadn't realized that a lot of their advisors are limited to selling only certain investments. And there may be other ones out there that are in the client's best interest or better interest, but that they're limited. So really, and that was the thing they said, you go home and ask your advisor, are they a fiduciary? Do they fall within the terms of that? And I got a pretty squishy answer to that, let me tell you, when I started asking the question.
Well,
so, yeah. Go ahead.
You make a really good point. I mean, I make this distinction in the book in the due diligence section of questions, and it's not, they're common sense questions. It's not like you don't have to be a finance expert to understand what these questions are. But one of the things is the advisor captive within an organization?
Yeah.
To whom that advisor owes, a duty to only deal with that particular organization's list of approved securities, or maybe they're sponsoring them, so that you have adverse selection. Basically, they're only picking funds that organization offers, or you have an independent advisor who can select funds from any that are available anywhere. And that, to me, that's an important distinction to make. Now, you may decide to go with a captive because the firm is big. This Wall Street, I guess, let me say something that sounds a little bit edgy, but if Wall Street's selling it, maybe you shouldn't be buying it.
Yeah.
Or maybe you should ask the question, if Wall Street's selling it, why should I be buying it?
Yeah. Yeah.
And so and by the way, I think that Wall Street performs an amazingly great service to our economy and to our capital system. But don't ever forget that they're in it for profit. They're not doing it because they're altruistic. They're doing it to make money. Well, I guess, I don't know if I said this, but in terms of I should have said it earlier on. And I say it in the book, and you made mention of this, but in terms of negotiation, all fees under the SEC rules are negotiable. Now, that doesn't mean your advisor's you go in and say, well, I don't want to pay 1%. I'm only going to pay, a third of a percent. They may not say, okay, but you have to understand that they are legally required to negotiate fees. Now, they may not want to negotiate them. They say, well, I know I'm required to do that, but I'm not going to lower my fee. Okay, well, that's a negotiation.
Yeah. Yeah.
Right?
Yeah. Absolutely.
The thing is, in life, it's interesting. In life, everything's a negotiation.
That's totally, you're speaking my language, Andrew. I totally agree.
But if you have the power, you have to believe you are a valuable resource to that advisor.
Yeah.
And why are you a valuable resource? Because if they get your account and they're charging you 1% a year, they're getting 1% a year for as long as you have the account there, and they're getting a little bit of that every day.
Yeah.
Do they send you an advice every time a fee is charged to your account? Do you get a little ping on your iPhone that says, we just charged you X dollars for your quarterly fee or your monthly fee? No, but you do get notices like that from other places.
Yeah.
The advisory business, my whole thing is, the world has changed so much in the last 20 or 25 years with Amazon and with streaming and with the way we're communicating now, which we couldn't have been doing 10 years ago, or well, maybe we could do it 5 years ago, but not so much. But now for sure. And so we're communicating what I hope is a beneficial information to people for very efficiently, I hope. And, but the one thing that hasn't changed is the legacy fee arrangements that so-called wealth advisors charge. They're charging on the same basis they've been charging sort of since the industry started.
Wow.
Which, by the way, the industry really didn't start. The institutional or the investment industry, so-called wealth management industry, didn't start until the the early 70s, actually. And why was that? That's because when Congress enacted the Employee Retirement Income Security Act, ERISA, when they enacted that, it kind of it created a whole new industry, because up till that point, the banks were the only people that were investing other people's money, or the brokers, the brokerage firms and the banks. But then this other industry, and it wasn't really regulated at that point, but the SEC, the Securities and Exchange Commission, kind of caught up with it after 10 or 15 years, and they started regulating the industry and requiring and it's fairly stringent requirements now to become an advisor. And the tests are rigorous tests. But anyway, so that's when the industry started. Before then, it was kind of the Wild West, and it was the Wild West in the early days of the industry too.
Yeah.
But they had not changed the way they're charging fees. The fees are an accident of history. Why should it be a percentage of assets? Let's examine that for one moment, if we can. Okay, so let's say a hypothetical $1 million, and you pay 1%. So that's $10,000 a year in fee. And let's say you make 7% a year, which most people would be happy doubling their money, and that would double their money in 10 years. Okay, 7% a year would, in 10 years, that'd be, if it's 7% a year, would be $2 million. So the fee on that $2 million now becomes $20,000. So you've gone from paying $10,000 to 10 years from now, you're paying $20,000 a year in fees. So twice as much fee. And you have twice as much in assets. And you say, well, that's okay. I have a lot more assets, so I'm happy. And, everybody's happy. Yeah. But in the meantime, the manager has benefited from earning 10% more than 10% of your profits. If you're only earning 7%, they're charging 1%, they're getting more like 12 or 13% of your profits every year. Yeah. Well, think about that.
Yeah.
Here's another number that's in the book. Okay, so 1%. Oh, it's only 1%. Well, that's nothing. After all, credit cards are taking 3 or 4% every time we charge something. So it's, I can live with that. Well, think about this for the moment. If you have $500,000 and an advisor is charging you 1%, and your gross return before the fee is 7% a year, which is a reasonable return to expect from, a prudently invested retirement account. Of course, we'd like to make more, and we, can do the numbers. And these calculators are available in an instant on the Google search, so everybody can do this calculation. So let's say 7% for 20 years, but let's say you're paying your advisor 1%. So you only get 6% a year. You don't get 7, you get 6. So the difference between a 6% return and a 7% return in 20 years is $332,000.
Wow. Wow.
Right. Now, if you choose to pay your advisor $332,000 over that 20 years goes by, you and I both know, in a heartbeat. Or seeming heartbeat.
Sad, but true.
Well, time flies. And so time is money. At compound interest is powerful.
Yeah.
1% is not a trivial number. It's a big number. If you want to pay your advisor an extra $330,000 over that 20 years because of the comfort factor that you have, let them do it. I don't want to deal with it. I can't deal with it. I don't care. I'm intimidated. I don't understand it.
Yeah.
Okay. But at least you're making a conscious decision. So when you go to the table, you ask, how much are you paying? How are you adding value?
Well, and let's talk about those questions for a moment, because I'm a big believer that preparation is a key element of effective negotiations. And you've mentioned a couple of times, and I know in your book you really focus on, make sure that you're asking the right questions of your advisor. So what are some of the main questions that you would suggest for our listeners that they make sure they're out there asking to determine if they're actually receiving true value?
I would say, what are your fees, but what are the total expenses that my assets will incur? Because the advisors may be charging a percentage of assets. Just call it 1% for the moment. It could be less or it could be more. It's frequently more, but let's say it's 1%. They also may be getting kind of back-end fees from mutual funds that they allocate your assets to, and they're called 12b-1 fees. In the mutual fund industry, as a marketing fee that's deemed in the regulations, 12b-1 is the designation for this fee. And they will get a percentage. The brokerage firm will pay back. I hate to use the the term that begins with a K, but it's payback. That firm, well, kickback, but yeah, just in case anybody's wondering. But I don't mean to make light of this, but it's like, wait a minute, it's like, wait, it's right on the table here. What are we doing? So how much are you getting in fees that are maybe other types of fees from these assets? So ask that question. And if they give you some squishy answer, then you have your answer that they're getting, that either they don't know, which is not good, or they don't want to tell you. The next question is, okay, I've had my account with you for X years. How much have I paid you in fees over that time? And how much, based on my strategy, let's say I invested in index funds that were consistent with the strategy that you have executed for me, how much would that have made over that same period of time? And they should be reporting that on a regular basis anyway. How much is your account done versus an unmanaged index proxy? Okay, for your account. Then they know what that is. Okay. And they should be reporting that. If they're not reporting it, please ask them to do so. And so the differences could be significant. And let's just say the manager is actually doing better after the fees. Well, you're in great shape, because as long as they're not assuming too much risk to do so, then you're in good shape. They're actually adding value. The next question after how much am I paying you in fees and how much money have I paid you over X years over and above an index fund return is, what are your advantages? What advantages do you bring to me, to my money, to my portfolio? And I go so far as to say, what structural advantages do you have? And that would freak them out. What's a structural advantage? Well, a structural advantage is a process. What's your process? How do you repeat this? Oh, well, we do this or we do that, or, it's kind of, we're not so sure. Well, that's no answer. What's your structural advantage? What is your discipline? What is your, what's your process? Is it repeatable? How can you show me that it is repeatable? How can you give me some proof that it is, you can repeat it? And these could be very threatening questions to the vast majority of advisors, frankly. Because I know from experience that most of the advisors are lovely people. They're super smart. They have nice degrees. They're well dressed. They're very engaging. They convey trust and confidence and so forth. And I get that, and that's good. They should do that. But how do they distinguish themselves in a portfolio context is the question. And if all they're doing is putting money into something that you yourself could buy, okay, then sorry, but that's not a value add. But so you have to determine what's their edge. What's your edge? And don't tell me we've got 35 PhDs and 3 analysts. We're on CNBC all the time. And if they're on CNBC all the time, that's a red flag in itself. But anyway, because they're just promoting, And I happen to know that many of the people on CNBC, only because I happen to know their private fund records, don't really comport with what they represent to, and they don't talk about it's illegal for them to talk about their performance. They cannot disclose that publicly on the private funds. Oh yeah, no, there's a whole nother level of, the SEC calls people retail investors, which to me is offensive. I think they're individual investors, and because all the people you can invest on a wholesale basis now. You don't have to be a retail investor. Everybody in your audience can be a wholesale investor. You don't have to pay retail. Ever. Okay. That's for one. But and then there are institutional investors, and they have $50 million or more. And that's the distinction that the regulators make. But I don't make any distinction. I say, look, everybody can invest for very little fee if they want to. All right. Now, why should they do that? Why can't they just leave that up to the big advisor or the small advisor? Well, you can. And if you're comfortable with that, if you know what that's costing you, it's perfectly fine. I'm not going to advocate that people release their advisors. I'm not going to do that. But I am advocating that they understand what the advisors actually do for them. And it could be that it could come down to, well, I'm here for you. I'll answer your questions whenever you have them. And, when the market goes down, and it will go down, if they're trying to tell you that somehow they can sidestep, a decline in the stock market and they can time the market, that's a reason to be very suspicious. Because the probability of doing so consistently and successfully is extremely low. And I know very, very few people. I mean, literally only a handful of really talented, skillful, brilliant people in the country can do that. Right? So don't buy into that part. don't let this account go down in value, because if it does, I'm gonna have an unpleasant conversation with you. Well,
Yeah.
they can't guarantee anything. So just
Yeah.
understand that. But if they convey comfort and you're paying for the comfort, so be it.
Yeah.
Okay. Well,
Yeah.
I know what I'm paying. I know what I'm getting.
But let's talk about risk for a moment. Like how should an advisor determine the specific risk and return preferences that you have, and how do they align them with a portfolio strategy? Because I'm not sure I've had that conversation, certain maybe 35 years ago, but not since. So
Well, that's one of the due diligence questions. Okay. How do you determine what risk score is?
yeah.
How do you determine my appetite for return and my tolerance for investment risk? Well, let's see. I don't know. You look like you might be a conservative investor.
Yeah.
The reality is, and the studies that have been done are, and these are subjective terms: growth investor, conservative,
Yeah.
capital preservation, income oriented. I mean, those mean different things to different people. And so the approach that I advocate is something that Daniel Kahneman, who's a Nobel Prize winning, now the late Daniel Kahneman, he just passed away a couple of months ago, won a Nobel Prize for prospect theory. Prospect theory is a series, it derives people's preferences for their tolerances for risk and return. And so what we do, and I'm not, sounds promotional, I suppose it is, but there's a complimentary risk assessment tool available on my website. There's
Nice.
no obligation, no cost, but
That's
it comes
great.
up with a score. Now, what is risk? Right? Risk is losing all your money, possibly. Risk is losing a lot of your money. Risk is after you've lost a lot of money, you sell out at the bottom, okay, and you don't
Yeah.
recover. Risk is not achieving your investment objective. The biggest risk is not to take risk.
Yeah.
If you're going to take risk, you have to assess it.
Yeah.
Risk and uncertainty are two different things. Okay.
Okay.
There are a lot more things that can happen that will happen than will happen.
Yeah.
Probably not going to have nirvana. We're
Yeah.
probably not going to have Armageddon.
Yeah.
We could. And you know that people's emotional reaction is exactly that when the market goes down, as it did as it did for that 30 days during COVID in February of 2020. It went down 35% in a month.
Yeah.
And people were extrapolating the worst. Oh my goodness.
Yeah.
The system is falling apart. The economy is going to go into depression. We're all going to starve. We're all going to die of, disease. I mean, and so that feeds on itself. And people were terrified, and they did depart from their strategy of staying invested.
Yeah.
And what happened on March 9th, not on March 9th, a month later, after that 30% decline, the market turned around and hasn't looked back since.
Yeah.
In the last four years. And there's no guarantee that will happen, obviously, but it did. What happened in other crises is the same phenomenon. People, their will is tested, their resolve is tested, and they have to be resolute. So how do you get resolute? By determining your tolerance for risk before it is exceeded.
Yeah.
That's tricky.
Okay.
That's hard to do. But so that's what I suggest. That's one of the questions. How do you determine my top Miss Advisor or Mr. Advisor? How do you determine my risk tolerance and therefore my strategy? And then, just as importantly, how do you structure a portfolio that is consistent with, that comports with my own tolerance for risk? And let me put a number on that. We look at risk from 0 to 99. The risk of the Standard & Poor's 500, which is a popular stock index that all institutional investors use as a benchmark. If they can beat the Standard & Poor's 500 over time, they will be very successful financially in their businesses. It's just a fact. For 100 years, the S&P has gone up 10% a year. And yes, during the Depression, it went down 85% over a 3-year period of time. In the Great Financial Crisis, it went down 50% over a year and a half. In the dot-com crisis, it went down over 50% in like 2.5 years. So these are terrifying intervals, okay, for an investor. So how do you navigate that? Well, if you know what to expect before that stuff happens, then you have a better idea of how you're going to respond to it when it does, and it will happen. It will happen. We will be tested. We don't know when, and we don't know how bad, and we don't know how long, but we will be tested. And so you have to be prepared for that. And so getting back to this risk score idea, the S&P 500 is a 75 risk. And that changes a little bit depending on the nature of the portfolio itself, but it's 75. And, the riskier, like NVIDIA would be 99. Or Tesla or some of the gamier stocks would be 99. And treasury bills would be 0 because there's no risk. You're going to get your money back. You're only going to make a few percent, and there's no risk. Most people, when they do this risk assessment, find out that their risk score is probably higher than they would be really comfortable with.
Yeah.
And then what do you do? Well, my approach is that let's just determine what your actual portfolio is, what the implied risk is. And I said earlier that risk is not the same as uncertainty.
Yeah.
Investment risk can be measured based upon past patterns of performance. And people could argue that all day long, but having been in this industry and having been practicing this with real live people, fiduciaries, responsible for other people's money, I can tell you that it works. It has worked. Will it work in the future? We don't know, but nobody can guarantee anything about the future. But I think it's pretty clear that human behavior repeats itself. And what happens with the price of financial assets is that they're nothing. Financial asset prices are nothing more than a reflection of the collective will, of the collective behavior of investors and what they expect and how they discount the future or how they assess future prospects. And that sets prices at the margin. At the margin means at the very top, there's going to be somebody who thinks it's going higher. There are going to be a lot of people who don't. And it's going to, so it's a reflection of human behavior. And to me, I don't know that human behavior has changed that much over a very long period of time. I don't think it has. You may differ with that. People may say, no, human behavior has changed. I don't think it's changed. I think there's still, to put it in crude terms, there's still fear.
Yeah.
There's still fear and there's still greed.
Yeah.
There's still flight or fight.
Yeah.
I mean, that's part of our being as human beings. Now, maybe that changes in time. Yeah. But right now there's fear and there's greed. And so the market bounces between those extremes. So we can measure, and depending on the interval of time, the probability of getting it right is higher the longer you go out with your horizon. So if I say, nobody is going to tell me what's going to happen with any accuracy over the next week or 2 or 3 or 4 or 5 in the market. But if you look out over, say, 5 and 10 years, the probability of being right goes up a lot.
Yeah.
And so the range of return. So what happens with the risk assessment thing is it projects what a person's portfolio will do. And it's like, say it's 70% in stocks and 30% in treasury notes. It will project what will happen with 95% probability over a 6-month period of time. And that's a pretty broad range, by the way. There's it's not like it's magic, but this is likely to happen. Is that something you can live with? If it's not, then we have to recalibrate the portfolio to reduce that range to a narrower range. And that's the way, that's a practical way. So your advisor should be able to tell you what the process is for determining your risk number, if you will, your risk tolerance, if you will.
Yeah.
And how does that comport with your return hopes, prospects, preferences? And because no risk, no return.
Yeah.
That's just a fact.
Okay.
You can't get return unless you take risk. So you have to calibrate the risk and manage the risk. And so those are kind of fundamental questions that I think it's a conversation that would be productive almost no matter what the answers are. Yeah. Because then you'll find out that, hey, this firm is they got it nailed down. They know what they're doing. They have a very solid process.
Yeah.
Or, it's kind of loose and.
Yeah. Or it's pretty loose. It's pretty loose. So I'll make sure for our listeners out there as well, we'll give you that link so you can go take that risk assessment on Andrew's website as well. I think will be useful. I can't believe how quick our time is going here, Andrew. So I want to ask too, because one of the things as you were talking that struck me is I get often these notices about changing, right? We've got this, sold this, no explanations, no financial impact or otherwise. But what should we be looking for in terms of how often an advisor makes changes to my portfolio? Just sort of
another question. That's another question in the list of due diligence questions. How often are you making changes and why? Because every time you make a change in a taxable account, know what happens. You have to pay taxes. You have less money to reinvest. And for whatever that's worth, Warren Buffett, who everybody knows, his favorite holding period is forever.
Yeah.
He doesn't make changes.
Yeah.
And he rarely makes changes.
Yeah.
Now, he's obviously a professional investor, but I'm just saying the average person shouldn't understand why are there advisors? How often should I expect changes in the portfolio? Why are you going to what? And then when they do make a change, if it's a meaningful change, and if it's not just a maturity of a bond that they have to then invest, why have you done that? But you should understand, basically, they should explain everything they're doing to you simply. And if they can't do it simply, then you should press them for simple answers.
Yeah, I love that. And I normally like to end, thank you. This has been a lot of information for some of our listeners. You may want to re-listen to the episode and make sure that you're sort of getting all of those points and reach out and ask some questions. I know that Andrew has all kinds of resources available on his website as well, which was refreshing to see. And I normally end, Andrew, by asking my guests, what is one of the greatest mindset shifts that you've ever had in your life? Doesn't have to be on this subject at all, but just something where you saw something differently or showed up differently as a result of it.
The most important thing, and I explain this in the book, is to think independently and know that I have the power to change my life. And
Mm,
I'm a student of Marcus Aurelius in that regard. And Marcus Aurelius, the philosopher,
yeah.
emperor, is right. You will experience what you believe.
Ah, I love that. And I wish we would teach that in elementary school because my gosh, that is powerful stuff right there. That when the moment we start recognizing that we are 100% responsible for our experience in life in terms of how we do, it is a game changer. So where can people learn more about you? You've mentioned your website. Tell our listeners where they can find out more about you, Andrew.
Well, the website is victoryroad.com. It's one word. Where's that come from? Well, my office address for 25 years was 500 Victory Road. Victory Road was a road that went through a shipbuilding plant that was Bethlehem Steel Company ran in the World War I, and they built 37
Yeah.
destroyers for the U.S. Navy at that plant in Quincy, Massachusetts, and there's Victory Road. So when I started my partnership in June of 2020, I said, victoryroad.com, that sounds like a good domain. So I took that. So there's nothing more significant to it than that was my address.
I love it. And it's so appropriate, Victory. It's uplifting, it's inspiring. So thank
Why
you
not?
so much for joining us today, Andrew, and sharing all of your insights. It was very much appreciated.
Well, it was my pleasure. Thank you.
And for our listeners, I hope you got lots of value from this episode. Like me, Andrew speaks quickly and he gave a lot of information in a very short time here. So make sure you take advantage of that, get those nuggets out and apply it in your life so that you can make smarter decisions with your hard-earned cash, and give the gift of sharing as well. Share this episode with others who you think are probably not getting the kind of advice or understanding that they should be having about their own investment strategies and where their money is going. And before we sign off today, I just wanted to share some ways that we can work together. If you are looking to practice more on purpose, or if you, whether for yourself individually or your firm, to change your culture, to be able to find ways to be able to practice with more purpose to get those better outcomes, then feel free to check me out at practicingwithpurpose.org. I have a whole range of programs available, from individual coaching to team management within the law firm. And that is a wrap for this episode. So until next time, go forth and find ways that you can practice on purpose. Find a better way to practice law so that you can rekindle your passion and make a difference in the world, negotiating your best life on your terms. Until next time, take care.